welcome everybody. It's 7 o'clock, August 29th, 2023. And we are recording. Let me turn my camera on. All right, here we are. And yeah, so if this screen looks familiar, you're at the right place. Thank you for joining us on this webinar today, maximizing your ROI with efficient asset management and real estate. There's a few things we got to go over before we get started. Philippe, you could take the wheel and go to the next slide. Next slide. So a quick disclaimer that I got to go over. Boost Capital Group does not provide tax or legal advice. This information is provided for informational purposes only and should not be construed as investment or advice or an offer or solicitation to buy or sell securities. So now that we got that out of the way, I'm your co-host, Jeff Rodriguez, and co-founder with my co-founder and co-host, Philip Schulligan. A little bit about Boost Capital Group. We are a real estate investment firm and provider of investment opportunities, risk mitigation, and portfolio diversification through alternative investments in the form of real estate. So we formed Boost Capital Group because we share a common vision, which is we believe busy professionals should be able to spend time with their families while also building a bright financial future through real estate investing. We've been in the industry for over a decade. We are invested in over 2,800 units throughout different areas of the United States, different states, and with a 20% IRR and 2 times equity multiple for the deals. One thing I didn't cover is if you have any questions throughout the presentation, feel free to drop it in the Q&A section, and we will have a Q&A at the end of the webinar. Next slide. So today we will be covering the subtopics in regards to introduction to asset management. We'll cover selecting a property management company. We will talk about the KPIs of asset management, when to replace your property management company, and some case studies and success stories towards the end. Next slide. So before you get to asset management, before you get to an acquisition, there's a lot of work that takes place before that. Work includes market research, underwriting, walkthroughs, inspections, submitting of letters of intent or LOIs, dozens upon dozens of LOIs before you actually get a true deal, negotiating these deals, and then capital raising. So the good news for passive investors here is that as a passive investor, you get this entire package, everything done for you. You get this entire package as an deal. So all the underwriting work has already executed and vetted before it's presented to a passive investor. Then a passive investor is involved in the acquisition of the asset that's presented to, and that's when the asset manager gets to work with the business plan. So if you go to the next slide, I'm going to hand it off to Philippe, where he's going to cover the introduction to asset management in real estate.
Thank you, Jeff. So my name is Philippe Schulligan, and I'm going to take over for this section, Introduction to Real Estate Asset Management. As Jeff mentioned, the real estate asset management really starts during the acquisition phase, basically doing market research and underwriting. And after the close of the acquisition is performed, that's when the asset management team will take over from the acquisition team. So the role really of the asset management team is to ensure that the business plan that was defined prior to the acquisition is properly implemented. And as a result, we're going to make sure as a asset management team that we maximize the value and the returns of the investment. So what are the four main roles of the asset management team? First, there is the management of the manager, meaning that there will be an on-site team, most likely. It could be remote though, but there will be a team that is going to handle the day-to-day activities, and more about that in a minute. But as an asset manager, you're going to review KPIs on a weekly basis with that on-site team, particularly occupancy, leasing, collections, and maintenance, but also the business plan execution, for instance, interior and exterior renovations, and also monitor any other actions that are ongoing at the property. The second role is reporting financials and distributions. So for doing that, and I think one very, very key result of that activity is that the asset management team will prepare a regular update for investors to give a status of how the property is doing. They will prepare a yearly budget and a regular financial analysis and produce reports to make informed decisions for the general partnership, the management team of the asset. And also, finally here in this category, they will prepare and send distributions. Next, we have the risk management, and that's definitely, and you'll see it in the case study, how there are many possible events that may happen. But I think the idea is to stay on top of political, financial, and economic news to mitigate any risk, right? And when anything of those things, those factors are coming into play, you want to do due diligence to maintain the investment at its top potential. So as mentioned, you're going to monitor the economic conditions. Is there a recession looming? I think these days that's one of the things that is discussed a lot. Is inflation going up? We had some of that some time ago. I think it's getting better, but also you want to monitor the some of the factors you cannot control that are part of your direct expenses for tax and insurance. And there are many areas in the country right now where tax and insurance is going higher.
So if I can real quick, so in regards to the risk management aspect, Philip mentioned the political aspect of things. As we know, when the election years, things start to get a little bit very, very political. So interest rates, the talks about interest rates shifting becomes a topic of discussion. So when planning out your exit strategy or your acquisition, looking at those type of news reports from the political aspect of things are things to consider when you're also making these deal decisions. It's kind of forecasted. It's not set in stone, but it's always look at financial data from previous election timeframes as well to use it as data for making these type of assessments for acquisitions or sales. I mean, it's not a crystal ball, but data-driven analytics and just using all information possible is always a good practice.
Yes, good point. Thank you. The final role is portfolio management. And here the idea is when you start getting larger as an operator, you're going to start having some opportunities that will present themselves. ranging from looking at insurance, for instance, at the portfolio level. So now, instead of going with, say, 50 units to an insurance broker, you're going to go and talk to them with hundreds or thousands of units. Now, you can discuss discounts from that standpoint. Same thing for any materials and equipment that you will purchase for doing your renovations. And same thing also for property management efficiency. Like the idea is if you can stick with using a single property management company for all your properties, then you can ask for a discount, and then it makes your life much, much easier because you're going to talk to a single company. Here we just wanted to make sure, we kind of jumped into the asset management, but we want to make sure we differentiate the roles of the asset managers versus property managers. We kind of mentioned most of these topics for asset managers, but we have to maximize returns, property value, be part of the acquisition and disposition of properties, operational oversight of what's happening on the property, business plan management, budgeting, financial analysis and reporting, market research and forecast, and something I didn't mention yet, but you're going to go on site on regular basis to see what's happening. Visit the team, make sure that everything is taken care of properly. Sometimes you're lacking a little bit of granularity and details when you're just doing your weekly call with the property manager. On the other side, here we have the property manager. They will handle the day-to-day management, deal with tenants, and make sure they are staying as long as possible. Manage contracts, for instance, for any no, I'm drawing a blank here. For I was taking care of the green spaces. That's an example of contract management. Vendor, if you are going to call third parties to do, for instance, air conditioning units repairs, they will do also all the leasing, compliance and administration. They will do the accounting, perform maintenance and turnover of units when a unit is made available. And that's not 100% of the cases, but often they will take care of the renovations as well. And back to you, Jeff, for property management company
All right, thank you for that. So selecting a property management company is a very important process and very important timing when it comes to a partner. The property management company is a partner in your deal. It can kill your deal or it can help it bloom. So it can be a nightmare or it can be a godsend when it comes to the property management's performance. So all the work has been done. You've been busy underwriting deals, finding deals, bringing investors on board. But if a property management company that you select is not up to par or has not the experience to manage a specific size property, that could be detrimental to the business plan. So we're going to go into a little bit more of property management company selection. Next slide. So when it comes to selecting a property management company, it's always important to look at what kind of experience they have. First and foremost, it's important for a property management company to have experience in the market or sub-market the asset is in. You don't need a property management company trying to figure out how that market operates. You want a property management company that is already vested into that area, knows the politics, knows the people to call, has a infrastructure already in place in order to be able to provide the best service they can. Now, when you're acquiring a property, you are doing a lot of due diligence. A property management company can help with that due diligence when it comes to underwriting. They can help you identify or determine if the returns or the rents are realistic and are achievable. If a property management company that doesn't operate in a specific market is not sure, but they tell you, yes, those rents are achievable, that could be a problem because in the long run, it's not meet the required income for the income to pay debt service, taxes, and everything that goes with managing a property. In addition, the structure or the organizational size of the property or the company. Some companies are really large and they would only work with you if you have, say, 200 units. Or if they're a smaller company and they want to increase their profitability and they want to sign with you and have you manage the property for you, but they're only used to 50 units or below, that is not a good selection for property management. So there's a lot of nuances to consider. Really large companies have regional managers that can provide services because they have a lot more infrastructure in certain areas. So those are things to look at. Accounting departments, make sure that they are able to, handle numbers, handle leases, handle rents. Leasing and maintenance teams on site. It goes back to being able to the infrastructure in a specific market and to be able to be the best partner for that specific asset. Next, we have pretty much a overview of the type of services a property management company can provide for you. This is not all encompassing, but these are just some basic services that you might want to look for from a property management company, and consider that it's size based as well. The smaller, the less experience, the less tools they have. The larger, those more requirements, because usually a syndication or a firm or whoever is hiring them needs a lot more information for their investors and for the deal to run smoothly. Next slide. And that rolls into the data reporting and software. There's a lot of software out there that large firms use in order to keep track of rents and financials. So you as the owner of a property, we like to get the financials and status reports that lets us know the pulse of the property, how everything is going. It helps the asset manager make decisions on the fly to whether to renovate specific units or to hold off because there's certain shortfallings that income needs to continuously come in. So that it's all part of the plan. It's all part of the calculations to make on the fly decisions. And there's always some way to get a report to identify what kind of software they use and if it benefits the plan of the business plan. And then we have leasing and maintenance process. So that's obviously important and essential for the life of the deal. You want to be able to have leases in place. You want to be able to have maintenance in place as well. If a tenant does not get maintenance done and they choose to leave, that takes capital out of the deal and creates shortfalls. So it's always important that a property management company has a good response time to be able to satisfy what the resident needs. And also it becomes deferred maintenance should a HVAC unit, or let's say there's water damage and the property management company kind of defers that maintenance, and it creates more of an expense to fix water damage. And that's one of the biggest issues that costs a lot of money when there's some type of water damage. Now, as you bring a property management company into the deal as a partner, you're under a contract. So it's a legally binding contract. So that's why it's a very important decision to make when you're assessing a property management company, right? In case you have to replace them, there's a lot of things to consider on how you terminate the contract. And they could be from their just shortfalls, keeping track of all the shortfalls, keeping track of, things that are not being performance based, requirements that there was things that were met that should have been met. So everything is under contract, but you have to have a way out as well. And then it comes down to the investment position. So vetting that management company, and also seeing if they're a good fit for the entire investment. I mean, I can't stress how important the property management company is, and there's some smaller operators that compete with property management companies that also buy smaller apartment complexes. So that's something to consider with what they are, what their mission is. So a lot of the larger property management companies just focus on being able to provide excellent service. You have smaller companies that also want to get involved in acquiring small apartment complexes. And so depending on the size, that can be the competition. So do you want to have your competition also managing your properties? Probably not. It probably wouldn't be a good fit. So those are things that are taken into consideration. Next slide. Okay. Turn back to Philippe.
All right. So is my sound okay? Okay. Yeah. The asset management KPIs, which are really ROI enhancers, and I think the idea here, why they are a way to enhance the ROI is they will guide your decisions in many cases. Because if you cannot measure the performance, then you're kind of navigating with a blindfold. So, and I know it's a little late in the evening, at least on the East Coast here. I don't want to be too detailed, but bear with us for a minute there. I think it's good for people who like charts and numbers, which it's my case. So the key things that you're going to look at in the KPIs, and it will be weekly indicators, key performance indicators that the property management company should prepare for you. They're going to be occupancy, leasing, collections, maintenance, unit turns and renovations, and budget to actuals. I pasted some illustrations there. I don't want to go over the details. I think the upper one is more what we are using at our level. I found this illustration online. It looks very nice. It's very interesting. Maybe not necessary to have all this fanciness here, but it was those are the tools available to do asset management, to perform asset management. So we'll go over each one of them a little bit more in detail. Occupancy, I think it's pretty clear. It's how many units are occupied, and you're going to look at the physical occupancy and pre-leased occupancy as well, to see if we're trending in the right direction. And also look at move-ins and move-outs on a weekly basis. And here the tip is to keep your target occupancy between 90 and 95%. And if you're thinking, so, well, why not 100? When you're looking at multifamily, if you're at 100, it means your apartments rent are is too cheap, and that's how, when you're at 90%, which is really where you want to be, that you're at the right level in terms of rent. Leasing, you're going to look at the number of lease expiring every month, the month-to-month leases, and try to convert those renters into yearly leases. Also, the number of prospects or leads and their sources for knowing what type of marketing is working. Look at the number of applications that are submitted, approved, cancelled, and declined. And also, an important, more recent phenomenon, you're going to check and monitor online reviews and make sure that you have good reviews for your property, because it's one of the factors that tenants will take a look at before moving in. The tip is you're going to adjust the strategy, the marketing strategy, as well as the rents with the property manager to make sure that there's enough leads in your pipeline, and also you're going to monitor the number of prospect to tenant conversion that you're going to you're going to get. And I think here a good target is between 10 and 20%. Next, collections. You're going to look at the total billed for the month, total banked, and total delinquent. That's pretty self-explanatory. Aim for 60% collection on the 5th of the month. If you don't have that, there may be a problem with people who are not paying their rents, which actually is covered in the next section. But otherwise, at the end of the month, you want to reach at least 90% in terms of collection. Next, you're going to monitor those tenants who are late for rent payment, and you are going to monitor evictions. So, for any tenant who is late, what's the balance of the account? What's the status of the communication? Are they responsive? Is there a payment plan in place? And when it's time to evict, unfortunately we're not there for charity, because we have to meet our our goals. We have to pay our debt on the property. We have there are a lot of obligations, and this commitment for the investors. So when it's necessary, you're going to evict tenants. It happens regularly, and actually these days a little bit of an uptick that we see throughout our portfolio. Next, maintenance, number of work orders and average time to close the work orders. Here you want to keep an eye out on any recurring issues and see if it's not time to do preventative maintenance. And also, make sure that you're going to close the work orders within 40 hours, because then, I think usually 40 hours is a pretty decent time frame, and tenants will be satisfied with that type of turnaround. Next, you'll monitor the units turns as well as renovations. So how many vacant units have been turned and all renovated, and here you're going to track the estimates. How many of them are in work? What's their status? Are they rent ready, or etc. Inspected. I could go. I'm thinking about many things. I just want to go a little bit faster. The tip here is you want to make sure that you have units that are rent ready for prospects and or leads who are coming at the property to take a look at what's available. Sometimes, when it's a very large property, you will want to have a model that is dedicated to stay as a model, but on smaller properties you cannot necessarily afford that. So just want to make sure that you have units that are rent ready at any time. And finally, the budget to actual. I put an example there, but you're going to work on a budget on a yearly basis with the property manager, and every month or quarter you're going to track: are we on track, are we under, are we above? And here actually we have some notes saying those are this is what happened, and maybe there's some corrective action to be taken. That's how we would take care of this opportunity to make some adjustments.
All
Jeff,
right.
back to you.
Yep. All right. Thank you. Yeah. So in section 2, we talked about identifying a property management company, hiring them, but hiring them sometimes leads to firing them as well. And yeah, the hiring and firing can be a very complex situation if there is no track of some trail of paperwork and things like that. So a property management company, as stated right there, can be worth their weight in gold or just an absolute nightmare. They are essential, as I stated before, for your team. But if the plan fails, which are not always perfect, I think Mike Tyson said it best: everyone has a plan until they get punched in the face. So if a property management comes in and states, hey, we can execute your plan, and all good news, all positive, sign the contract and work with us and pay us our fee, everything's great until there is breach of contract and such. Go to the next slide, please. So breach of contract can be something as failure to collect the rents, which affects the bottom line. They're not paying the bills, so you get liens put on the property from contractors. And failure to maintain the property, that's a big one, because it causes more deferred maintenance, which at the end of the day causes a lot more money to fix these problems. And just fail to perform services. And that's a breach of contract. An example of breach of contract. Keeping track of all these type of things is important. Just like the contract, the legally binding contract, there's ways on being able to go separate ways when it comes to these type of things, because the deal is going to continue. Tenants are still going to go in and out, and you need a property management company to be able to handle those type of requirements. The accountant statement reliable. There are questionable charges, fees, things that were not discussed. Those are grounds for terminating a contract. Those are things that, as an asset manager, needs to stay on top of, and the property management company needs to be very transparent when it comes to these accounting issues. Therefore, when it goes back to section 2, we're talking about different softwares that are being used in order to track these type of expenses. This is why, because you want to see those accounting statements. You want to see those numbers, because the numbers don't lie most of the time. But those are important things to consider, and property management company can be replaced by another if statements do not make any sense. Next slide.
Yeah, actually, one note on this section, because you mentioned software, and that's most, if not all, the recent modern softwares, they allow you to drill very deep into seeing what's behind a specific expense, and you'll be able to go to the bill that is associated to the expense, and it will be available to you as asset manager. So when you review your monthly P&L, profit and loss statement, if there is anything that is out of the ordinary, you would go to that level and track, what's behind the actual number to look at this particular bill or invoice, and that's where then you can have a conversation with the property manager about these things. All right.
Great point. Now, when it comes, we're still talking about tracking, not only tracking bills, tracking expenses, also response time. A property management company needs to be able to keep track of response times and request work orders and such. That can lead to vacancies, which again affect the bottom line. So when it comes to ensuring that the company is doing all their requirements based on the contract or obligation, they need to respond appropriately, not only to the request from the asset manager, but also the tenants, the maintenance crew, anybody that they are supposed to be paying or keeping track of. Response time is crucial. So those are things that can also lead to a firing of a property management company if they're not able to keep track of these type of things, to be able to show, hey, we responded in an appropriate time. And down to prolonged vacancies, if the management company is not answering the call for maintenance from a tenant, the tenant is obviously the most important thing in regards to income, because if there's no tenants, then there's no income. So we got to keep those tenants happy. If the property management company is just ignoring these calls, it becomes a problem. Philip earlier talked about going on Yelp or Google and seeing all the comments, the
Reviews.
the reviews, right? So people see those, and there is like a cycle when it comes to those. They could go be like 2 to 3 years of terrible management, a year or two of good management, maybe 3 or 4 years, and then it becomes a cycle. So it's either the property management company comes in, does better work, and then another one gets picked up, does bad work. So those are things that are also affecting the vacancies. If a property management company can't do a basic thing of answering the call to a tenant to fix any discrepancies, it becomes a problem. Not being able to pay taxes, repairs, maintenance, debt service becomes an issue when there is no cash flow. And which leads to poor tenant retention. Tenants don't want to stay if their requests are not answered. That's pretty much what it boils down to. And sometimes if a property management company can't keep tenants, they might bring on tenants that barely criteria. So if there's a tenant that, and it has happened, just for occupancy, some tenants are brought in, whether they meet the income standards or requirements, they may not care. They could just bring in people to increase that occupancy that Philip was talking about, that 90% occupancy. And that tenant may not be able to pay the rent. That tenant may not be able to, he may not have a job. Credit score does not qualify, but now you have yourself a problem with no payments and have to pay out of pocket even more for an eviction. So that becomes a problem in the long run with the net operating income total of that property. So all this boils down to, if they're not keeping their side of the bargain, then a new property management company needs to be hired and replaced in order to meet the requirements. And
Right.
I'll hand it off to Philip.
Case study and success story. So in this section, we're going to talk about historically my second deal, Dogwood Trace, which is a 168 apartments complex located in Memphis, Tennessee, that was acquired in 2018 for $4.2 million. I put a copy there of a recent post that I made on LinkedIn, talking a little bit about this property. But it's a more, I think, in-depth view of particularly the asset management aspects of things. So we had investors, passive investors invest $1.1 million in this property. We worked with a repeat sponsor. We had a good experience in repositioning assets in Memphis, and the business plan was pretty straightforward. Increase the rents through bringing, and I see a typo, rents to market and improving collections. We were going to lower the expenses by reducing the insurance cost and maintenance cost. And in order to do that, basically there was some investment made upfront to reduce these expenses. And finally, there was a tax incentive program with the pilot program that exists in Memphis. And pilot means payment in lieu of taxes. And the idea behind that is when you invest in real estate in the city of Memphis, they will freeze your taxes for 10 years, if I remember well, at a fraction of what the tax should be. So first, let's talk about the challenges. Actually, after getting lower, the insurance cost, I just mentioned that the insurance cost increased year over year. And you see, it went from $25,000 to $44,000. So that was kind of a bad surprise. Also, we had increase of expenses on deferred maintenance. So, things that needs to be seriously need to be repaired. Our initial assessment was okay. Like those things didn't need necessarily a lot of money, but and that's a little bit of the problem of with older properties, and it was from late 60s or early 70s. This one, you better have a lot of reserves, and we went from 16,000 in capital expenses to 190,000 over a period of 3 years. So those first two bullet points shows. And that's something I think we discussed during our last webinar. It's very important to have sufficient reserves to be able to withstand that type of expenses. Same remark on the third bullet there, because we were impacted by COVID-19, so our collections were impacted, and at that point we decided to stop the distributions for a while. Eventually, I think between the CARES Act and other programs, we're able to recover some of the money that we couldn't collect. So we ended up not too bad. However, it did really impact 2021 quite a bit, and we only were able to resume the distributions after that period. We also had a fire. It wasn't, still 3 units were damaged, and tenants had to be relocated, and the units had to be completely renovated. But insurance took care of everything, and nobody was injured. Unlike the fifth event there, a week after we put the property for sale, mid 2021, there was a triple shooting at the property, and we got really worried. What it meant for potential buyers, but actually it didn't have much of an impact because the market was really really hot. So the successes, you know, I think throughout the ownership of this property, we were able to maintain mid-90s occupancy. As we discussed, you know, that's where you want to be. We are able to push rents consistently as well. So we are doing the right things at the property to attract and retain tenants. And also, you know, we're able to reinvest the money into renovating units. So that's what that was a little bit like the recipe to make that investment successful. And we ended up pushing the value of the property far beyond our initial forecast, and, you know, have some numbers on the next slide. But there were two sides of the coin there on what helped us to achieve that. Operations, like I mentioned earlier, like we took well care of the tenants, and, you know, that helped us get referrals, and we kept occupancy high, and we kept you know, we're able to push rents, you know, a little bit every half year, every year, we're able to raise rents. Also, you know, from a market standpoint, and I think that's, you know, still true to this day, there's a housing shortage. We discussed that maybe in our third webinar, or maybe the first one, actually, when we spoke about the opportunity to invest in commercial real estate multifamily. And, you know, especially in Memphis, you know, there was, at least at the time, there was a strong housing market. You know, I think it's these days it's and I think everywhere it's a little bit tough. You know, when you don't have super population growth. I believe Memphis is pretty stable, but, you know, like the rental market is not as good. Also, we benefited of the compression of cap rates. So here is the target that we had when we launched that deal in 2018. It was to do 1.9x on equity multiple, meaning that if you invested 100,000, you would have, in the deal, you would have received 190,000. That represent an internal rate of return of 16%, and it was over a 5-year period. And actually, one of my pretty savvy investor recently was asking me about what's the internal rate of return. You know, I think the very, very short answer is that it's showing how hard is your money working. The higher the IRR, if you compare two deals, the better and the harder your money is working. And maybe that's something we can talk about in a future webinar. The actual the realized numbers, we did 3.9x. You know, we're very, very happy with those returns. You know, I think the market was very favorable. The IRR, the math is 43%, and we were able to achieve that in a period of 4 years. But as I always say, past performance is not necessarily an indication of future results. Jeff?
All right, awesome. All right, so pretty much in conclusion, well, there's one thing. So in this presentation, we were maximizing your ROI with efficient asset management. So why not effective? So in regards to effective and efficient, you know, they're pretty much sitting there. But with efficient, not only is it, you know, producing your desired results, but wasting material, time, energy, and human capital. So we focus a lot on the details of investing down to the words we pick on our presentation. So when performing a deal, we focus on the nuances and all detail, in order to be able to bring and provide the investors the best returns we can. Consider market conditions and everything. We look at a lot of data and things like that. So um, pretty much boils down to adopting all data that is available and keeping on top of everything that you could possibly control. You can control what you can control. You can't control other things outside of your scope. But we do the best we can. And at the end of the day, you cannot make progress without making decisions. So whether you choose to invest in real estate, crypto, stock market, make a decision that's best for you, that fits your investment criteria. So pretty much that's the conclusion of this presentation. We have a next slide that goes over a coming up presentation. Philip, if you want to go over that real quick.
Yeah, we're launching a different format for, and it will be weekly, number one. Number two, it will be a Zoom call, and the goal of that Zoom call will be to do some education for passive and active investors on a more specific topic. And so we'll spend about 20 minutes on a specific topic, maybe 10 minutes of Q&A more or less. And then we want to build a community, so there will be as well some networking. We'll do breakout rooms in the Zoom call, depending how many attendees we have. Maybe we can just do some networking and talk about whatever attendees have on their mind, and what they're doing, where they're coming from on their path to investing in real estate. So
we have Phil has a question. In regards to property management, how much is too much to pay a property management company? Is it a certain percentage or a dollar value?
Yeah, so let's start maybe with the typical ranges. Let's say I've seen out there very large properties. Usually you would pay 3%. So I'm talking about the 200 plus units. The smaller you get, the higher the expense will be. So you may, let's say at 50 units, you may be at 6-7%. Now you need to realize and understand, if the property management company, they're coming from a single family, mostly in their portfolio background, they will charge you for new lease. They will charge you for lease renewal, but they will not charge you for payroll, right? Because usually they might do something remote and so on, in terms of property management. So it's my point here is to say, look at all the expenses, and by the way, in that context, they may charge higher property management fees as well. And the other side is people, property management companies who are doing only multifamily, they will just charge a flat fee, nothing for lease renewal and lease new leases, but you will pay also separately for payroll. Hopefully that answers your question. Dollar value, yeah, I don't. I know I've heard some company charge by door, which is a little weird. I think at the end of the day, you just need to compare several property management company. On my single family, I believe I pay 9%. Depends on the market. And on multifamily, we're ranging from, we're just changing property manager, 675 on a smaller 40 unit recently, but otherwise larger properties, it's 3.
Yeah, and that's why multifamily, there's the benefit of economies of scale. The more under one roof, the cheaper it is per, but in the grand scheme of things, it's still pricey. But like Philip said, a single family can be 9-10% for that asset, but obviously if that asset is vacant, there's 100% no income. So that's pretty much what we look at with the comparison of single family. A lot of single families, there's 9-10% throughout versus under one roof, multiple properties at 3-4%.
So to go back 1 second on this event, I pasted the link in the chat if you're interested in joining us. Education/networking. Actually, that's probably something we need to add on our illustration here. Our next slide is regarding a new opportunity that we're going to start. And actually, it's the very first time we talk about it, but because we just decided to be part of that opportunity. It's called Heather Ridge. It's located in the Dallas-Fort Worth MSA or market, more specifically in Arlington, Texas. So as if you've received our recent emails, we had an opportunity recently also in Dallas, Texas, and we love that market because it's the #1 large metro in terms of population growth in the country. So it's really strong market. Again, pretty simple, very similar parameters to the prior deal. We're going to upgrade 100% of the units and be able to collect $300 of rent increase. And also we had a great opportunity on that acquisition because we purchased from a distressed owner who saw his mortgage payment increase insanely to the point they couldn't sustain it anymore. So they sold at a discount, or they're selling at a discount to us. We're looking at the 2x equity multiple in 5 years, and the average cash on cash it's about 6% with an IRR of 16%. Let us know if you're interested. Actually, our contact information is here. You can send us an email at investorrelations@boostmycapital.com. Otherwise, you can scan the QR code, and I believe it will lead you to our website. Right, Jeff?
Yes, it should. Yes, it should to the sign up.
Otherwise, if you have, you can contact Jeff or me directly, just with our first name at boostmycapital.com. We can leave this open for an extra minute to see if there are any other questions. But until before we close, we want to thank everyone for participating, and thank you for your interest. Hopefully we'll see you Thursday, and if not, we'll see you at the next webinar, or maybe on a call with us if you want to know more about what we're doing or the deal we spoke about.
All right. Well, thank you everybody for showing up and taking the time with us. It's 8 o'clock. We appreciate your time, and we do not want to take too much of it. So thank you for showing up, and we'll see you next time.
Thank you, everybody. Bye bye.